Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024 October-November Paper 2 question number 1. This is Paper 2, which consists of 4 questions. 2 of them will be of 30 marks and 2 of them will be of 15 marks. And the total time limit for this paper is 1 hour and 45 minutes. Since question number 1 is of 30 marks, ideally you should be spending about 35 minutes in order to solve this question. And in this video as well, we'll be attempting to solve it under 35 minutes. So without any further delay, let's get started. Ahmed is a sole trader. He does not maintain full accounting records. He provided the following information for the year ended 30 June 2024. So we have been given a list of information. Let's take a look at the first question. We need to prepare the statement of profit or loss for the year ended 30 June 2024. We also need to use the space provided on page 4 to show our workings. So we have to show the workings for our revenue, cost of sales, rent, electricity charges, motor expenses, depreciation, and other workings. In this case, before preparing the statement of profit or loss, let us first go over all of the additional information and do the correct workings so that we have the final figures to be included within our statement of profit or loss. Alright, let's take a look at the first information. Payments and receipts during the year included the following. We have been given the carriage outwards, cash sales. Okay, the first thing that we need to calculate was revenue, and revenue is just going to be the sum of our cash sales and credit sales. So let's include this amount first. Cash sales is of 5,200. So for the revenue, this is just going to be cash sales plus credit sales. And the value for cash sales is 5,200. In order to calculate the credit sales, we always need to refer to the sales ledger control account. So we can prepare a sales ledger control account roughly right here. We know that sales ledger control account includes the trade receivables, and trade receivables is an asset, which means that the opening balance of the trade receivables should be included here. The closing balance should be included here. And the credit sales that we need to calculate will be included on the debit side. So let us look for these values first. We are looking for the opening balance of trade receivables and the closing balance of trade receivables, which has been given right here. This is our opening date, this is the closing date. So the opening balance is 21,100 and the closing balance is 18,500. Let's write it down. So we have 21,100 and 18,500. And on the credit side, what we include is the amount paid within our bank account from the credit customer. So these are the receipts. Let's look for this amount as well. This will be given within our payments and receipts. We are looking for receipts from credit customers, which is given right here. That's the amount of 102,600. If there is any sort of discount, any sort of irrecoverable debts, we need to include that as well. Let us look for those. So in this case, we have electricity, general expenses, motor expenses, rent paid, payment to credit suppliers. Okay, I don't think we have any information regarding any sort of discount. So that should be all in order to calculate our credit sales. And in order to calculate it, we first need to calculate the total from our credit side, which is 102,600 plus 18,500, which gives the amount of 121,100. So 121,100. Now the credit sales will be equal to 121,100 minus 21,100, which results in 100,000. Okay, let's add that amount. Now the total revenue will just be 5,200 plus 100,000, which results in 105,200. Okay, now for the cost of sales, we just need to start with our opening inventory, which is given right here, but the closing inventory is not given. So we need to figure out the correct value for closing inventory as well. Inventory at 30 June 2024. So this is the closing inventory. It was valued at 15,880. This included damaged items costing 960. That will be sold for 1,100 after repairs costing 340. Okay, I'm just going to write down the formula first in order to calculate the correct closing inventory. So we always start with the incorrect value. And in case of damaged inventory, what we do is we first subtract the cost of the damaged inventory. So cost of damaged inventory will be subtracted. Then we need to add the selling price of that damaged inventory. And then we need to subtract the repairs cost. Let's do that. So in this case, the incorrect value is 15,880 and the cost of the damaged item is 960. It can be sold for 1100, which means that this will be the selling price of the damaged inventory, and we have the repairs cost of 340. Let's include these amounts. So the incorrect value was of 15,880, the cost was of 960, the selling price was of 1100, and the repairs cost was 340. This gives the correct value of closing inventory to be 15,680. Okay. Now for the cost of sales, we also need the value of the purchases. And there was another information given regarding purchases. All purchases are made on credit. So we need to calculate the credit purchases. And whenever we need to calculate the credit purchases, we need to refer back to the purchases ledger control account, similar to what we did when calculating the credit sales. So let's just prepare the format roughly. So purchases ledger control account deals with trade payables, which is a liability. That means that the opening balance will always be on the credit side and the closing balance will be on the debit side. And these are the balances of the trade payables. Let's look for those values. So trade payables is given right here. The opening balance is 8,800 and the closing balance is 6,300. Let's write it down. We have 8,800 and 6,300. So in this case, the credit purchases will be recorded on the credit side, whereas the payments made to the credit suppliers will be recorded on the debit side. This is what we are trying to figure out, which means that we need to look for the value of the payments, which was given within the information regarding payments and receipts. It's right here, payments to credit suppliers, that is of 61,240. So 61,240. Now, in order to calculate the credit purchases, we first need the total from the debit side. That will be 61,240 plus 6,300, which results in 67,540. Now, in order to calculate the credit purchases, that will be 67,540 minus 8,800, which results in 58,740. Okay. Now, we need to look for rent. Okay, so during the year, Ahmed took goods costing 420 for his own use. This will be included within the cost of sales while preparing our statement of profit or loss. An irrecoverable debt of 300 is to be written off. So this will also be included as part of our expenses within the statement of profit or loss. Ahmed wishes to maintain the allowance for irrecoverable debts at the same rate as in the previous year. Okay, let's do the workings for the allowance for irrecoverable debts first. In this case, we can see the allowance for irrecoverable debts at the beginning of the year. So this is the opening balance of 1,055. We first need to figure out the rate. And I'm just going to write down the general formula. So for allowance, I think we can show the workings under other workings. So the formula for allowance for irrecoverable debt is just going to be the trade receivables multiplied by its rate. In this case, we first need to figure out the rate by using our opening balances. The opening balance for the allowance for irrecoverable debt was 1,055, and the opening balance of our trade receivable was 21,100. Now we can easily calculate the rate. The rate is just going to be 1,055 divided by 21,100, which will be 0.05. We can also write this as 5%. Now we need to figure out the closing balance of the allowance for irrecoverable debt. For this, we need to look for the closing balance of our trade receivables. Let's take a look above. The closing balance was 18,500, but before we multiply it by the rate, we also need to subtract the irrecoverable debt, which is to be written off. In this case, that will be 300. So we need to subtract the 300 from 18,500, and then only can we multiply it by the rate of 5%. Let's do that. So that will be 18,500 minus 300. Then we multiply this entire amount by 5%. This gives the amount of 910. Now we need to compare the opening balance of allowance for irrecoverable debt to the closing balance in order to see whether there was an increment or a decrement. The opening balance was 1055. The closing balance is 910. Clearly we can see that there is a decrease. And whenever there is a decrease in allowance for irrecoverable debt, this will act as an income within our statement of profit or loss. So we need to calculate the difference. That will be 1055 minus 910, which results in the value of 145. Okay. So we are done with this. The 8% bank loan was taken out on 1st April 2024. No interest has yet been paid. So we need to calculate the interest as well. Let's take a look at the amount of the bank loan. It's of 3,000 and the rate of interest is 8%. It was taken out on 1st April 2024. Let's calculate the interest charge for the year. So we can calculate the bank interest right here. And it was taken out on 1st April 2024 and our closing date is 30 June 2024. So we first need to count the months for which the loan was used during this year. So that will be April, May, June. So only 3 months. The amount of the bank loan is 3,000. The rate of interest is 8%. Now we need to multiply it by 3 out of 12 because this 3,000 times 8% relates to 12 months, but we only need the bank interest for the 3 months. So times 3 by 12. This is just the use of a unitary method. This gives the bank interest to have the amount of 60. Okay, we are done with that information as well. Then Ahmed started the business on 1st July 2022. On that date, he purchased a motor vehicle for 24,000 and fixtures and fittings for 3,200. No other current assets have been purchased since that date. We need to calculate the depreciation now. Motor vehicle is 20% per annum reducing balance method. Fixtures and fittings is 10% per annum straight line method. So straight line method is quite simple. We can just multiply this rate of 10% to the cost of fixtures and fittings, which is 3,200. Let's calculate it. So this one is for fixtures and fittings. The cost was 3,200. The rate is 10%. This gives the amount of 320. Now for motor vehicles, we follow a reducing balance method and it was first purchased on 1st July 2022 at the cost of 24,000 and the rate of interest is 20%. Okay. So this is 1st July 2022. This is 1st July 2023. This is 1st July 2024 and this is our closing date. We are trying to calculate the depreciation for this year, which is the second year, and we are following a reducing balance method. It means that we also need to find the depreciation for the first year. For the first year, the depreciation will just be cost times rate, which is 24,000 times 20%. That will be 4,800. Now for the second year's depreciation, the first year's depreciation will act as the accumulated depreciation. So we need to subtract the 4,800 from the cost of 24,000. That will be 24,000 minus 4,800 times the rate of 20%. This gives the value of 3,840. So this is the correct depreciation for motor vehicles. Again, let's take a look at our information. So we are done with depreciation as well. Motor expenses paid included 1,140 for motor insurance for the 12 months to 31st August 2024. So 12 months to 31st August 2024 includes September of 2023, October, November, December, these 4 months for 2023, and for 2024 it includes the months of January, February, March, April, May, June, July and August. So that will be 1, 2, 3, 4, 5, 6, 7, 8 months for the year 2024. And in this case, our closing date is 30 June 2024. So it should only include the amount till here, but it also includes the extra charge for these 2 months, which will be a part of the next year's financial statements. So we need to remove the 2 months amount from the motor expenses. So we first need to figure out the corresponding amount for the 2 months out of the 1140, which is for the 12 months. Let's do that. So for 12 months, the amount is 1140. We need the amount for 2 months. That will be 1140 divided by 12 times 2. This is just the use of unitary method, which gives the amount of 190. And this 190 is the amount for the next financial year, which means that this should not be included in the current year's financial statement. So we just need to remove this amount from the amount given for motor expenses. Let's take a look above. So motor expenses paid was 4,250. And we do not have any other adjustments. We only have adjustment for rent and electricity here. So for motor expenses, we just need to remove that amount of 190. That will be 4,250 minus 190. This results in the amount of 4,060. Okay, now we need to calculate the correct amount for rent. So we always need to start with the amount that was actually paid. So rent paid in this case is of 16,800. Then we can see that we have other payables. This is the rent accrued. So this is the rent yet to be paid. And we have rent accrued at the start of the year. So for accruals at the start of the year, we always subtract it, because this is the amount to be paid for the last financial period, not the current year. Then we also have rent prepaid, but rent prepaid is at the end of the year. And rent prepaid at the end of the year should always be subtracted, because this amount is for the next financial year, not the current year. So let's do that. For rent, we start with the actual amount that was paid, which was 16,800. Then we need to subtract our opening accrual of 600 and subtract the closing prepaid of 1,800. This gives the correct rent to be included within our statement of profit or loss to have the amount of 14,400. Okay, let's figure out the electricity charges as well. Again, we need to start with the amount that was actually paid, which is 1,920. And the adjustment is for other payables. So again, this refers to electricity accrued. Like I said before, the accruals at the start of the year should be subtracted, because this is for the previous year, and the accruals at the end of the year should always be added, because this is the amount yet to be paid for the current year. Let's do this. So for electricity, we start with the amount that was actually paid, which was 1,920. For our starting accrual, we subtract that. For the ending accrual, we add the amount. Now this gives us the correct value for the electricity to be 1,880. This should be included within our statement of profit or loss. Okay, I think we went over all of the information. For general expenses paid, there is no adjustment given, which means that we can include this entire amount of 3,600 as an expense within our statement of profit or loss. So is the case with carriage outwards. That should be included as an expense as well. Alright, let's start our statement. So we always need to start with the revenue, and we have already calculated the correct amount. So we just need to write down the amount of 105,200. After revenue, we move towards our cost of sales. Cost of sales starts with the opening inventory. We then need to add our purchases, which we've already calculated below. There was also goods taken for own use. Goods taken for own use should always be subtracted. Then there was no carriage inwards, but we have been given the closing inventory as well, so we need to subtract it. Okay, let's start with the opening inventory. Opening inventory is of 12,640. Then purchases we've already calculated. That will be 58,740. Then we have been given the goods taken for own use, which was of 420. So we need to subtract this. Then we have calculated the correct value for our closing inventory, which is 15,680. Then we need to calculate the total for our cost of sales. That will be 12,640 plus 58,740 minus 420 minus 15,680, which results in the value of 55,280. Then we need to subtract this amount from our revenue so that we get the value for the gross profit. That will be 105,200 minus 55,280, which results in 49,920. Now, if there is any other income, we need to add it. In this case, we calculated that there was a decrease in allowance for irrecoverable debts, which should be treated as an income. So we need to include this 145 as part of the other income. Let's add it. So add other income, and that will be the decrease in allowance for irrecoverable debt. That's of 145. Then we need to figure out the total of the gross profit and other income. So that's 49,920 plus 145, which results in the value of 50,065. Then we can move towards subtracting all of our expenses. Okay. So let us first include the expenses that we have already calculated. That will be rent of 14,400. Then we've also calculated electricity charges of 1,880. Then we have calculated motor expenses of 4,060. Then we've calculated depreciation on fixtures and fittings of 320. Then we've also calculated the depreciation on motor vehicles of 3,840. Then what else we have? We have the bank interest of 60. Okay, then we have a few other expenses which needed no adjustment. The first one is carriage outwards of 1,040. Then we also have the irrecoverable debt of 300. And we have the general expenses of 3,600. Okay, so we have included this, we included the depreciation, we included the interest, we included the allowance for irrecoverable debt, goods taken for own use. Yeah, I think we've included pretty much everything. So we can calculate the total of our expenses. So that will be 14,400 plus 1,880 plus 4,060 plus 320 plus 3,840 plus 60 plus 1,040 plus 300 plus 3,600, which results in the value of 29,500. Now we need to subtract this expense from our total of gross profit and other income. So 50,065 minus 29,500, which results in the value of 20,565. This will act as our profit for the year. This is all for the first part of this question. Let's move towards the second one. Now, explain with reference to an accounting concept why adjustments 5, 6 and 11 on page 2 were to be made to the financial statements. Okay, 5, 6 and 11. So information 5 is that during the year, Ahmed took goods costing 420 for his own use. Okay, after taking the goods, now the goods will belong to his personal use and not to the business. There is a concept called business entity concept, which refers to the business and its owners as two different entities. So that is the accounting concept that will be applied here, because now the cost of goods taken by Ahmed for his own use should be charged to his drawings, because they are separate from our business expenditure. That is his personal expenses, not the expenses of our business. Then for information 6, an irrecoverable debt of 300 is to be written off. So this is part of our expenses, right? And whenever we include expenses, our profit reduces. It means that we are applying the prudence concept, which states that profits should not be overstated. In this case, by reducing the irrecoverable debt as our anticipated loss, we avoid overstating the profit for the year. That is all for 6. And for information 11, motor expenses paid included 1,140 for motor insurance for the 12 months to 31st August 2024. And in this case, we did not include the amount relating to the 2 months, which was after our year end of 30 June 2024. In this case, we are applying the matching concept. What we are doing is we are matching the expenditure of the insurance for the current year to the benefit of the same accounting period. Let's write it down. So goods for own use will be the business entity concept. And in this case, the cost of goods taken by Ahmed for his own use is now his personal expenditure, which is why this should be treated as drawings and not included as business expenditure. Now the second one is irrecoverable debt, where we apply the prudence concept by treating the anticipated loss by including it as an expense. The business avoids overstating its profit for the year. Then for motor insurance, we apply the matching concept. Matching concept ensures that we match the expenditure of the insurance with the benefits of the same accounting period. So to match the expenditure of the insurance with the benefits of the same accounting period. That is all for the second part. Now let's move towards the third one. We have been given additional information. Ahmed has been offered the opportunity to purchase larger premises for 85,000, which would allow him to increase the sales revenue of the business. As he does not have sufficient personal funds to make the purchase, he is considering two options. So option 1 is to apply for a bank loan to cover the whole purchase price. The bank loan would be repayable over 10 years and interest would be payable at 8% per annum. Option 2 is Ahmed's brother has offered to join the business as an equal sharing partner. He would introduce all of the cash required to complete the purchase in exchange for a 50% share of future profits. We need to advise Ahmed whether he should go ahead with either of these options. Justify your advice by discussing both financial and the non-financial factors. And this is of 7 marks. So whenever you are writing down such advice questions, always reserve 1 mark for your final decision, then divide the remaining marks equally among your options. So in this case, 3 marks will go for option 1, which is the bank loan. Then the remaining 3 marks will go towards option 2, which is for partnership. Now, you need to write 3 points each, but you should not mention all disadvantages or all advantages. You should either write down 2 advantages, 1 disadvantage, or you should write down 2 disadvantages and 1 advantage. Let's start with option 1. So option 1 is the bank loan. Now, the first thing relating to the financial factor is that when we apply for a bank loan, interest would be payable, and whenever we have to pay interest, it will definitely reduce profit. And this is for 10 years, which means that the profit will be reduced for the next 10 years if the business goes ahead with this bank loan. Let's write it down. The first point is that interest payments would reduce profits for the next 10 years. And whenever there is a bank loan, there is a question of whether or not any sort of security or collateral is required. So we can ask that question as well. Would the bank require any security or collateral? Because they need to hold some of your asset in order to give out such a large amount of a bank loan. And we also know that we have an existing bank loan of 8,000. So we can also ask whether or not the bank would agree to provide further loan capital. Let's write it down. Would the bank agree to providing further loan capital? Okay, now we can move towards option 2. This is of partnership. So in this case, Ahmed's brother would finance the cash required to complete the purchase in exchange for a 50% share of future profits. The very first financial factor we can write down is that Ahmed would have to forego half of future profits. So Ahmed would have to forego half of his future profits. Then the second thing that we can write down is that since this is a partnership, we also require some sort of skills or some sort of knowledge from Ahmed's brother. So we can question whether or not Ahmed's brother will add any additional skills or knowledge to the business. Will Ahmed's brother add any additional skills and knowledge to the business? Then for the last point, since this is partnership, there is always a risk of any sort of conflict. So we can ask the question, will the partnership cause friction between the brothers? So will the partnership cause friction between the brothers? Now, based on these factors, we need to make a final decision, and we also need to justify that decision. In this case, I personally would suggest Ahmed to go ahead with option 2, because this will provide the necessary capital in order to avoid the long-term liability, which is the bank loan. Because having a higher long-term liability is always risky for the business, because there is a chance of Ahmed not being able to repay that bank loan in the future. Let's write down the decision. So Ahmed should go ahead with option 2, as this will provide necessary capital to avoid long-term liability, which is the bank loan in this case. Alright, that is all for the third part as well as this entire question. If you found this video useful, make sure that you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.